Trump's tariffs trigger dollar crash. Is America losing the inflation war? Trump's sweeping tariffs have sent the United States dollar tumbling. The greenback's steep decline, its sharpest in 4 years, shattered the Federal Reserve's hope of reaching its 2% inflation target. But that's just the beginning. Gas prices have hit new highs, store shelves are showing double-digit inflation, and import costs are snowballing. While exporters initially cheered the falling dollar, companies dependent on foreign inputs slammed the brakes. Households tightened spending, interest rates dropped, and the federal deficit widened. Investors are shifting into euros, while risk premiums are rising on United States Treasury bills. So, if Washington doesn't ease its trade war stance, will this dollar spiral permanently sabotage America's inflation fight? Let's take a closer look at how President Donald Trump's tariff policies have driven the dollar down, and what that means for the United States economy. Before we dive in, don't forget to subscribe to the channel, turn on notifications, and like the video to stay up to date. The dollar began summer 2025 on a sharp decline, dropping to 1.18 against the euro as of June 30th. According to data from LSEG, this level hadn't been reached in 4 years, a clear sign of the pressure Trump's tariff strategy is placing on global markets. Though the tax plan launched in mid-April started with a 10% flat rate, successive rounds of added tariffs eroded investor trust in the greenback. The DXY index dropped to the 96 range, breaking below levels last seen in February 2022. The euro surged as traders priced in retaliatory measures from export-heavy economies. On Forex desks, euro demand quickly outpaced dollar orders, creating a lopsided market. With the dollar losing nearly 13%, American exporters initially rejoiced. Computer hardware, aviation parts, and machinery from United States hubs like Dallas and Chicago suddenly looked cheap in euro terms. Manufacturers reported a rise in European orders, but the celebration didn't last. The cost of importing key components like Dutch-made photolithography machines rose 15% in dollar terms. As profit margins thinned, production timelines were pushed back. The core goods index, a key measure of domestic inflation, rose 0.7% in June. The Fed's disinflation path was thrown off course. Meanwhile, the weaker dollar quickly drove up gasoline and energy prices. The Energy Information Administration reported crude oil hitting $93 per barrel. Refiners hiked pump prices to maintain margins, driving national average gas prices close to $5 per gallon. That's a 16% year-over-year jump. As a result, the University of Michigan's Consumer Sentiment Index dropped to 47, its lowest in a year. Retailers tried to absorb some cost pressures, but electronics and household goods still saw price hikes. According to Adobe's Digital Price Index, online shopping cart prices were up 12% year-on-year as of June 14th. The trade deficit picture remains complicated. While a weaker currency tends to support exports, retaliatory tariffs from key partners like the European Union, Japan, and Canada, ranging from 15 to 25%, have dampened demand. Although preliminary Commerce Department data showed a $10 billion narrowing in the goods trade gap in April and May, services exports took a hit. United States tech firms lost revenue from software licenses, and consulting contracts weren't renewed as clients slashed spending. So, the improvement in the current account remained modest. Oxford Economics projects that the dollar's weakness could trim the external deficit by $75 billion over the next year. But inflationary effects may outweigh those gains 2-1. On Wall Street, a sharp reversal is underway. As inflation-adjusted interest rates go negative, foreign investors are exiting treasury bills. Euro-denominated assets are gaining favor. Long-dated United States bonds are under pressure. Though 10-year Treasury yields dropped to 3.45% in early July, the 5-year forward inflation expectation rose to 2.9%, raising risk premiums. Interest payments are now rivaling defense spending, meaning any sudden rate shock would force Washington to choose between raising taxes or cutting expenditures. The currency slump is also, reshaping bank balance sheets. Euro-denominated assets are gaining value while dollar liabilities, they're shrinking. Hedge funds are cashing in on the arbitrage, but traditional banks are facing tighter regulatory constraints and scaling back credit. This has led to cooling activity, especially in manufacturing. The PMI index fell to 49.6 in June from 51 in May, signaling contraction. If it stays below 50 for several months, job creation will stall, potentially nudging unemployment up. Globally, the dollar's weakening has forced central banks to really rethink their reserve strategies. The IMF reports that the dollar's share in global reserves fell from 63% 2 years ago to 58.8%. Meanwhile, the euro's share climbed to 26%. If the weak dollar persists, this reserve rebalancing may accelerate. The United States will then face higher borrowing costs as surplus capital in foreign currencies seeks better yields elsewhere. Moody's raised its 2026 forecast for average 10-year Treasury yields from 4.2% to 4.7%. Domestic wage demands are also heating up. The Teamsters Union requested an 8% hike for long-distance truckers, citing the eroded value of fuel allowances. Grocery unions are seeking cost-of-living adjustments in cashier pay. If large-scale wage hikes become entrenched, core services inflation will rise. Fed Chair Jerome Powell flagged this risk in the June policy meeting, warning that further dollar weakness could delay interest rate cuts. There's one bright spot: tourism. A weaker dollar has made the United States more attractive to international travelers. Foreign visits are up 12% in 6 months, hotel occupancy is breaking records, and Manhattan retail sales are showing single-digit gains. But tourism's share of GDP is limited and honestly can't counterbalance the rising cost of imported goods. Trade logistics are suffering too. Tariffs have disrupted the flow of containers along Eurasian routes. West Coast ports reported an 8% drop in container throughput in mid-June. While shipping lines rerouted through ports like Ho Chi Minh City, the drop in Chinese exports left a gap. Empty containers piled up in storage yards, raising equipment rental costs. And those freight hikes will soon hit consumers. Big tech is navigating this landscape cautiously. Companies billing exports in euros are using their FX gains to pay down dollar debts, improving their leverage ratios. But United States hardware firms may face a talent exodus. Skilled engineers may prefer working in Europe, where wages are stronger in euro terms. A new chip plant near Berlin is already attracting attention. This kind of brain drain could hurt United States innovation in the long run. Agriculture is another sector watching developments carefully. Soybean futures rose on dollar weakness, but China's 20% tariff stopped shipments from Louisiana. Demand is shifting to Brazil. The USDA cut its grain stock forecast, which will raise feed costs and hurt the livestock sector. Energy exports, especially liquefied natural gas, are more profitable with a weaker dollar. But Australia and Qatar are pushing for contracts priced in other currencies. The Shanghai Oil and Gas Exchange has started settling deals in yuan. If non-dollar energy trade becomes standard, countries may reduce their dollar reserves, lowering demand for United States debt. The housing market isn't spared either. Mortgage rates were expected to dip, but instead held steady at 4.98% for 30-year fixed loans. Foreign buyers are interested, but visa rules and safety concerns are holding them back. Home sales and new construction both dipped by 3% in the second quarter. The insurance sector is also under pressure. Treasury yields, when adjusted for inflation, have weakened. This threatens insurers' ability to match returns with long-term liabilities. Moody's placed 4 regional insurers under review, raising the odds of higher premiums and lower household spending. The dollar's global role is now under political scrutiny. Members of the Senate Finance Committee are proposing a European-style strategic price pact rather than easing tariffs. A draft bill would let the Treasury intervene more aggressively in currency markets. But burning through reserves could backfire, and markets know the Treasury can't keep up interventions forever. Looking ahead, the dollar may test 1.22 against the euro over the next year. If it keeps falling, United States exports will benefit, but domestic inflation will intensify. Should inflation expectations crack, long-term interest rates could surge, making deficit financing even more expensive. If reserve diversification picks up speed, the dollar's global standing could erode. There's a potential upside scenario. Trump strikes a deal with Europe, suspends tariff hikes, and de-escalates tensions. That would slow the dollar's slide, restore some investor confidence, and allow the Fed to cut rates. Investment would rise and productivity might follow. But if Washington keeps stoking uncertainty, capital flows may never fully return. Most likely, a middle path. The dollar stays weak but doesn't collapse. Annual losses stabilize around 15%. Inflation flattens near 3%. The Fed takes a cautious stance. The trade deficit narrows slightly, but interest costs on the budget keep climbing. Reserve shifts continue, but the dollar remains dominant, for now. In response, industries are adapting. Manufacturers are rethinking supply chains. Banks are tweaking their foreign exchange mix. Funds are moving toward commodities and gold. And government voices are leaning into fiscal responsibility. But the final outcome is still in flux. Talks between Washington, Brussels, Beijing, and Tokyo in early 2026 will set the tone. If tariffs are lifted, the dollar might bounce back. If not, the decline could drag on. Until then, every business and household must learn to navigate the challenges of a weak dollar world. The lesson may be valuable, but the price will be high. What's your take? Let us know in the comments. And don't forget to subscribe and turn on notifications to keep up with our latest content.